You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. And it's that time of the quarter again. We start to pile up some of those questions that have been coming in over the weeks and address them in the most concise way possible. This one's an interesting one. It's one that I wanted to tie in to really all the noise that's been going on over the last few weeks with regards to the budget, the issues with regards to that, and the opportunities that come out of Minister Kerry's announcements to the R code changes made over the last few weeks. Where there is chaos, there is opportunities. And that's exactly why I called this podcast Navigating WA's Property Market. For the first time in a while, it's not just business as usual. It's not just get yourself a property, watch it grow, make sure that you can cover the interest costs. It's taking us back to a time now where it's probably 2017, 2018 with regards to the level of research, sophistication you're going to need to take to make sure that your investment going forward is optimized and isn't just riding the same surfboard wave as everybody else. The great thing about it is that one of the things we've been asking for the last couple of years, hoping for as many investors, many people on the buy side, is a bit of breathing space when it comes to making those decisions on properties that are coming to market, getting opportunities for off-market purchases as well, and that comes with more properties being on the market. And finally, that's become a reality too. So whilst plenty of people out there are nervous about what that looks like, what that means on the ground with the buyer-seller dynamics at home opens, let's remember the fantastic opportunities that come from having more options of properties to buy and less people to compete with at that negotiation table as well. So what we'll do is we'll get straight into a few of the questions that I think most poignantly represent the queries and fears of people in the market right now. This first one comes from Tommy. Tommy asks, Trent, Perth's total listings have finally crept back over the 6,000 mark in June for the first time in over a couple of years. And you're right, Tommy, the last time we had that many properties on the market was actually April 2023. So it's been 3 years. And properties are taking a few days longer to sell. Well, that's right. Properties are now taking 18 days to sell. It was down at 8 or 9 days a few months ago. We last saw that about 3 years ago as well. So you can see the correlation in days on market and properties on the market. That's pretty interesting to see. The question is, are we finally seeing the top of the Perth market, or is this just a mid-year breather? To be honest, I think it's more complex than that. The answer actually is also pretty simple. It's a number of factors, and those factors are noise, probably being the most obvious one, and that's noise coming from media, coming out of the big story about the budget. And the interesting reality of that is that the budget measures things that are actually going to happen with regards to negative gearing capital gains tax don't actually happen for another 12 months. Nothing's happened in the space that you can actually attribute to the realities of legislation. It hasn't come in, it won't be coming in for 12 more months. So it's simply sentiment and expectations coming out of what will happen in 12 months that has limited or reduced the amount of demand in our market by about 200 properties per week, and we're going down from an average of about 900 to about 700 properties in a week, per week. And surprisingly to many people, the amount of people selling actually has just stayed stable. You'd think that with the stock on market going up, that meant more people are selling. Actually, the same amount of people are selling every week. It's just that the amount of people taking properties off the market is lower, and therefore the stock on market is accumulating more and more each week. That's how you get from 1,800 properties in January to 6,000 properties, is essentially a couple of hundred a week. Just keep adding and adding as there's an imbalance between people buying versus people bringing their property to market. So that's the first one, is sentiment, future expectations and fear because of noise. That noise has people making less proactive decisions to demand property, and therefore stock on market increases, and you just see that balance. The second part, which is actually the most impactful part and the one that people, I guess, are talking about less, even though it is still in the media, that's interest rates. What we've actually seen, to be frank, is rates of growth in Australia generally start to drop from November. And that's really when the rate rises started to come into the fore of people's minds again, both happening and conversations about it. And therefore, most specifically, the impact of price growth dropping or going into negative territory in places like Sydney and Melbourne is actually coming from the reality of affordability, serviceability over there. And then the dampening growth, the getting 0.5% per month and not 1 to 1.5% per month growth in places like Perth, from the same factor of just the limiting ability to get finance because 1, rates are higher, so serviceability is lower. 2, banks are already now actually taking out negative gearing, even negative gearing benefits in your serviceability even before the negative gearing impact comes in a year's time. And 3, a whole swathe of investors in the trust space have also received less serviceability too. So those are the realities, I think, that are actually limiting the price growth scope with regards to demand. Now, the real question here is, as it's always been to people around the barbecue, is will my property go up in value in the medium to short term, or am I expecting it to go down, and what will I do about that? And I'll bring you back to the first principle fundamentals. Is there still an undersupply of property, of the amount of properties we're building every year versus the amount of people coming in who demand those properties, who need the basic need of a roof over their head? So do we have an ability to bridge the gap of the 40 to 50,000 houses deficit we've built up over the last 5 years, and how quickly will we do that? So the question is, are we at a point where we're building half the amount of properties for the amount of people coming in, given our people per residence is at about 2. So 2 people per residence. If we have 60,000 people come in, are we building 30,000 homes? The answer is still no. We're still building less than 25,000 homes per year. We're getting more than that in approvals, but it's taking more than a year per house to build, and therefore there's a lag, and you get less than the amount of approvals per year, if the math makes sense in your head. So we're getting between 20 and 25,000 houses built a year. That means that at a max, we have a carrying capacity of maybe 50,000 people. Well, we're still bringing in more than 50,000 people per year, and we don't have scope to increase that 20 to 25,000 because of the trades we've got. So not only are we not building enough every year for the amount of people that are coming in, we're not building enough to start chipping away at the deficit. Therefore, all else being equal, and servicing still not being a breakneck problem like it is in Sydney, which is their limiting factor, their reducing factor actually, prices will continue to grow in Perth. However, because servicing is reducing because rates are rising, and because sentiment has an artificial dampener, I guess, on the demand side as well, with investors pulling out of the market, for now, price growth will just be less than we thought it was going to be this year. But it won't be negative, because to be negative, sellers need to sell more than buyers need to buy. And we don't have that reality. That reality is represented by a balanced market of 13,000 properties. That won't happen this year. And it may or may not happen next year based on where interest rates go. And the interesting thing about that, if I was to then segue into that point, is the more the East Coast property market, and therefore economy, because the property market is a massive driver of those economies, flag, the less stamp duty these states get because there's less transactions, the less employment tax these states get, the less economic activity happens in the public space as well. We start to see not even technical recessions, just absolute recessions in places like Sydney. Half the market, half the voting population. Then you start to see things happen with regards to monetary policy. And as we've always explained on this podcast, counter-cyclical monetary policy against where WA's market is. Where we don't really need rate drops, we will get them, and they'll come next year, which will then lead to an expansion of price growth versus what we're experiencing right now. So for all those people getting nervous about all the noise, turn the TV off, stop reading the newspaper, and switch it back on again early next year. And I promise you the fundamentals wouldn't have changed much, and you'll start to see a bit more hope and opportunism across the country, which then filters into news in Western Australia as well. The fundamentals are still as good as they've ever been, both at a state government level with regards to surpluses and filtering down to work, immigration, and therefore price growth opportunities, because we just are not solving this problem the way it needs to be solved. So therefore, no, we are not seeing the top of the Perth property market. We are seeing a regulation from frenzy and FOMO to something a little more manageable, still in a growth phase. And it's hard for people to believe, because I think most people think in a binary nature. It's either positive growth or it's negative growth. If it's not 20%, it must be negative 20%. No, you can have 20% one year and you can just go down to 3% the next year. That's still growth, and it's still manageable, and you average it out and you still got an asset that's growing faster than inflation. So chill out, stick to your first principles, on the investment properties you're buying with regards to what makes investment property a good one versus a bad one, and you'll be all good. Next question comes from Jared. Jared asks, the federal budget proposing to axe negative gearing on established properties starting July 27. Yep. Should I rush out and buy an established investment property right now to get it grandfathered, or is that a bit of a tax trap? It's an interesting question. My brain hasn't really thought in that sense of, oh, geez, I better go and buy these properties. And the first point I would make is that even though the changes, Jared, occur on the 1st of July, the cut-off date for when you could have purchased a property, the grandfathering, is actually budget night 2 months ago. So you've already missed the boat. It's probably the easiest way and the quickest way to explain it is it's not even a possibility. You can't be buying property over the next year and expecting it to be grandfathered. The last date was the 12th of May, 2026. I hope that quickly answers what you're after. Next question comes from Tim. Tim asks, because the budget preserves full negative gearing and the 50% CGT discount for new builds, won't everyone now just pivot to house and land packages on the outer fringes of Perth? Is that now the safe bet? I guess that's the unintended consequence, Tim, of this policy is that in trying to continue to incentivise new builds, which I agree with, I understand, and especially in a place like Perth, which is very different to a place like Sydney and Melbourne where most of the new builds come from. Remember, these guys rely much more on apartments and higher density infill, so that would be their sort of outer fringes equivalent to the house and land packages that we see here. I guess the reality is that they want new builds coming in. They don't want to disincentivise it. They want to offset or create an imbalance of incentive for investors if you're still going to be a property investor, which in Australia certainly won't be dissuading that culture anytime soon. That's the unintended consequence, is that it's going in Perth, is going to crowd out the space where the first home buyers, the people they're trying to protect, would generally be playing, because that's where they're normally marketed to when they go and build a home through the builders. The builder's easiest path to find them a block of land is to just call the land developer and say, hey, what do you got? And that's normally on the urban fringe. So, yeah, there will be investors that are for the same negative gearing benefits and CGT benefits they've been sold on for decades, or 2 decades. They'll be going out to the urban fringes and continuing in the same way, I think, as they always have, to compete with first home buyers. I do think in the short term, though, it will just be less of them because of the sentiment impact. But in the long term, yeah, there will be probably the same amount of people who are happy to go and invest in the house and land space. And there's a bunch of people that just aren't, because they don't see that as being a valuable or good investment option, despite the fact in the last 5 years it's probably been a great investment option just because of passive growth. So, yeah, that is an unintended consequence. In places like Sydney and Melbourne, for example, it's probably going to off-the-plan apartments in that space too. So are they the safe bet? No, they've never been a safe bet. At certain periods where you've seen massive inflation-based replacement cost growth, they've been a pretty good bet, but I would always be sticking to staying within 20 k's of the city. If you can find a house and land package 20 k's of the city, I'd rather be doing that than on the urban fringe. That still would be a better option because it's new product. And to be frank, I would then go and push it to the next level and say, well, hey, if I'm not going to be a developer because I'm not sophisticated enough, I'm not going to do small scale subdivision, and I get most people aren't doing that, then the next level would probably be buying a house and land package or a brand new build from a small scale subdivider who's doing a duplex or a triplex. And that's the golden goose there, because there will be far less rentals available in the urban inner areas, because investors will probably start pulling away from that given a lack of negative gearing in those higher cost, lower yield areas. And therefore, they'll be rare as hen's teeth buying new investor product in the urban infill areas. So that'd be my pick. If I was going to buy a passive house off someone, it would be a new townhouse or a new triplex unit in the equivalents of your Duncraigs and your Warwicks and your Willagees of Perth. Yeah, that would be where I'd be going with that right now. That's the safe bet. The next question comes from James. James asks, over the last quarter, Perth unit growth actually outpaced houses, with an annual growth sitting now at 27% for unit growth, which would probably surprise a lot of people, to be honest. In a city that traditionally loves a backyard, why is the bottom end of the market suddenly exploding? I think it would be pretty obvious, James, that the bottom end of the market has been exploding for a couple of reasons. One, the 5% deposit scheme, and units obviously fit in that perfectly under the $850,000 space for a lot of suburbs, or just more than usual. And also, just generally, the last quartile in the market, the fourth quartile, the bottom quartile, is around anything under $850 now, and everything has been pushed up in that space because of it. And you'll note that the highest performing area in Perth, despite the last quarter of negative sentiment around the investor space, which is highly correlated, is the lowest quartile of Perth, because not only you got the 5% deposit scheme, but also it's one of the last bastions of relative affordability for the established and house and land package areas of Perth. So that feeds into what I was saying before, in that the biggest impactor, the biggest driver of house price growth in the country, and when I say that, growth and negative growth, is interest rates. It's affordability. It's whether the banks can or want to play ball with people who are on the fringes of serviceability for what they're doing on a daily basis. And that is most impactful, most critical at the low deposit space and the low income space. We're going to continue to see high performance from that last quartile until interest rates start to drop and the floodgates open further up the price scale, where most of Middle Perth gets a bit of a breather on, one, their current mortgage, and two, their servicing to upgrade as well. Next question comes from Tanika. Tanika asks, we are seeing headlines that Sydney and Melbourne property values are starting to contract. It continually gets represented as the Australian house market dropping. Great pickup, Tanika, and appreciate your sophistication on recognising that. While Perth is still grinding upwards. If the macroeconomic pressures are national, why has Perth completely decoupled from the East Coast right now? Well, the macroeconomic pressures aren't national, Tanika. Melbourne is an absolute basket case. It is broke. That government is broke. And there's a stink over that whole city, which is causing broad-scale lack of investment, lack of confidence, and people to leave. And when people leave, they need less houses. So now there seems to be green shoots on the optimism with an election coming up, and I assume the Labor government there will finally get kicked out for a younger, more sprightly premier on the Liberal side, which will be interesting for the national story. And rents are going up as well, but don't be fooled. This Adelaide and Brisbane story has nothing to do with the Perth story. WA's economy is operating in a different stratosphere for jobs and public spending than any other state in the country. It has been doing for years. It is the place you want to be if you want good work. It is the place if, as a business owner, you want to be because your margins are still strong. And it's just a great place to live. The Australian story is just so irrelevant. It's nearly as irrelevant, the US story, as the Sydney story is to where the Perth market is. So the first thing I would say there is, as you referenced in your question, we all need to stop giving two hoots about what's going on in Sydney and Melbourne's market and care more about what's happening in our state GDP, in our state mining space, in our state public spending, in our state budget surpluses, all of that. That's what matters as a trickle down to how well off West Australians are and how much we spend on our property, and then layer that in with where interest rates are at. That's what matters. And therefore, whilst sentiment is national because we have a national federal budget, and whilst interest rates are national, the reality is they are impacting Perth to the same degree as they are impacting the East Coast. Perth is just more resilient. Perth can withstand the heat in the kitchen more than Sydney and Melbourne can, more than Adelaide can, because it is more resilient as a market and as a state economy. And therefore it is experiencing downward pressure on price growth, but it isn't experiencing negative price growth because it has so much fat in its equity position and in the general economic status of our great state. That's probably the best way I can explain it, and I hope that makes sense to people. Okay, the next question comes from Aaron. Aaron asks, Trent, with Minister Kerry announcing that in a year's time we should hopefully see a brand new set of R codes, and more specifically all of those R20 properties now becoming subdividable and not just the corner blocks. Good pick up, Aaron. Where's the opportunity here? Does this change the investment strategy you would advise for a mum and dad? Look, Aaron, I think it does. It actually makes the investment strategy I've been pushing on this podcast for the last 8 years even more pertinent. We've always spoken about your goal as a mum and dad investor being to be a small-scale developer of land in Perth. Getting that 700 square metre block and subdividing an R25, an R30, an R40 block into 2 or 3. Now it means that you can get a 700 square metre block and subdivide an R20 block into 2. What it's doing is it's broadening the opportunity for mum and dad investors, who are really the only people that are going to be in this space, because the big guys don't care for it. It's too small. It's not enough money. It's too much stuffing around. It's too many neighbours, right? So they're not going to be competing on it. They don't care. What it does, it allows the horde of mum and dad investors that are fighting over the scraps of the last few thousand investment subdivision opportunities in Perth in the R40, R30, R25 space to go, whoa, now there's an extra, Mr. Kerry says, 50,000 properties available through places like Kiara, Lockridge, Beachborough, Langford, Thornley, Girraween, Kundula, Marangaroo, that are sitting there in that 80s, 70s space where the houses are all 3x1s on 700-ish square metres that are all R20. Bang. Now you can subdivide them, throw a house at the back, and there's plenty of food to go around for everyone. So the strategy stays the same. Buy a property that you can either knock down and do a side-by-side 2-lot subdivision, 2-lot build, or if you don't have the cash, keep the existing house, rent out the front house, subdivide the backyard off, sell it off if you can't build, and go from there. I think it's a great opportunity for all those guys who have had that 1 or 2 properties, got a bit of equity over the last few years in the market and go, bang, I'm ready to go. That's the strategy. It doesn't change. Those are the suburbs straight away off the top of my head I'd be focusing on that currently are mainly R20 suburbs and close enough to Perth, and start buying them up over the next 12 months before everyone else figures it out. I hope that helps. And the next question comes from Natalia. Natalia asks, what are your thoughts around the current thresholds for the first home buyers grant and where it's set at? Is it an appropriate amount? And what would be an appropriate deposit as a first home buyer? Natalia, thanks for the question. And it's great to receive a question from someone who's looking to buy their first home. No, the first home buyers threshold is nowhere near relevant and acceptable in my opinion, especially when it comes to the stamp duty space. Currently, to buy a median priced home as a first home buyer in Perth, you have to pay about $32,000 in stamp duty. Now, your older brother could have bought that property 5 years ago and paid no stamp duty when he was buying it for 450 grand, simply because he was older than you. Now, that's not fair. It is massive bracket creep windfall from the state government. It is greedy, and it is stealing from young people, in my opinion. Stamp duty is the worst tax possible, along with payroll tax, and it causes so much friction for the goals of young people to simply own their own home like their parents and grandparents did. We should scrap it completely, in my opinion, but that would take a Goliath effort. So yeah, the threshold should be moved up from $600,000 to $850,000 or indexed so that we never have to talk about it again, but it hasn't been so far. And what is an appropriate deposit amount? Well, look, ironically, on the $820,000 purchase, your stamp duty will be $32,000. With the 5% deposit scheme, your deposit only has to be $41,000. $41,000 plus the $32,000 in stamp duty, you'll have to be at $73,000, unfortunately. That takes a bit of time for a young person to save these days with the cost of living and ongoing plans for young people to be travelling a lot more than their parents did. But if your priorities are set in the right order, I would 100% be using that 5% elbow scheme to your advantage and buying into an established area. And if you can, coupling it with that strategy we just spoke about of buying a house in somewhere like a Kiara or a Lockridge or a Marangaroo or a Thornley or a Langford that has future subdivision potential, and using that down the track when you've got the cash to do that strategy, even if it's 20 years from now. Once you own it, no one can take it off you. Good luck, Natalia. Paige asks our last question. Paige asks, do you think property investors should hold on now or let go due to the changes of negative gearing? Look, tax systems will come, they'll go. They are a feathering on the value of property over the long term. And if you bought a good property, this is not a reason you should be selling it. If you can afford to keep it, and I'd like to think that for most people, you're not even negatively geared anyway, you're positively geared because your rent covers the mortgage. And if it isn't, that couple of grand a year in negative gearing benefits also shouldn't be breaking the bank for you. I'd like to think that you've got a bit more buffer in the first place. If those are the realities for you, then don't sell unless you have something better to do with your money. A protest sale is not going to be a win for you, and Albo's never going to know. So 100% hold on to that property. If it's a good one, this has absolutely no impact on it being a good one in 5, 10, 20 years. Write out the noise, and a year from now, we won't really be talking about it. Guys, thanks so much for listening in. I hope you've all enjoyed that, and we'll be speaking next week with another Suburb Spotlight. Pretty excited to also mention we'll get Michael McGowan in from the HIA and Minister John Kerry in the next few weeks as well.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!